What makes stocks risky? Basic question, but if you don't know the answer to it, you really need to know the answer before you continue investing in stocks. Now, this isn't financial advice, it's entertainment, infotainment, but I'd say that any investor in equities or stocks would be wise to know what makes them risky. And I think intuitively you probably already have an understanding. And what I'm going to do is underpin that intuitive understanding with some financial theory. And in this video, very quickly, I'm just going to give you a brief rundown of literally what makes stocks risky, what is risk in the stock market and in equities, and what typical finance theory says about all that. Well, if you went and got a master's degree or a PhD in finance, or you know, any of the related fields like, econometrics, financial economics, mathematical finance, even economics and some business finance, you generally have a sense of what I'm about to say. And here it is. What makes stocks risky is the volatility. Finance typically, and now if you go to some of the wildest places in the investing world, some people could start to disagree with this, but that's advanced stuff. Not for now. We'll talk about that advanced stuff later on. Subscribe to my channel for that, and like this video if I'd appreciate it if you like this video and like this content. Like the video for the algo, and then give me a beautiful subscribe, not a like, a subscribe, because I want to stay connected with you and produce more content. So if you enjoy this content, give me a subscribe, and please give me a comment as well on what you want to know more about. But the basics is this: volatility is what makes stocks risky. Now, I said there are some other potential thoughts on that, but generally 95% of the main finance world is going to basically equate risk with volatility. Risk with volatility. So what is volatility? Well, volatility is simple. It's just the up and down of things, the up and down nature of things, right? The inherent nature of equities to go up and then down and then up and then down. So it's a very basic term, and it's kind of an intuitive term. Now we can go a step further and a step further after that as well, and we can start quantifying volatility, which we're not even going to try to do in this video. But you can quantify volatility, and you can have a volatility metric. The VIX, the VIX attempts to be kind of a quasi volatility metric, and you kind of have you potentially have some other volatility related metrics, but you can try to quantify it. But I'd say that's not the point for a beginning or an intermediate investor. The point for a beginning and intermediate investor is to have a very deep intuitive understanding of volatility, to understand what it is, how it is. And the only way you could develop that, and truly I believe the only way you could develop that, is by studying financial markets in the past, literally seeing how equities and stocks and indices moved in the past over time and how they continue moving today. The best way to do that is to be invested, like I am, to be invested in the equities markets overall, so you have an incentive to keep track. Again, not a financial advice, and maybe investing in equities isn't even the right choice for you. But generally speaking, volatility is that aspect of equities and stocks and of other investments like crypto, where you're uncertain about what's going to happen tomorrow, because things go up and down, and they do so in an unpredictable, almost chaotic and random way, more random than chaotic. Uh, they're literally unpredictable, and you don't know where tomorrow is going to be. You don't know where the day after tomorrow is going to be. You simply don't know. And unless you're all equity investors are exposed to this type of volatility, basically, unless you take some kind of hedging positions, which you could, that would limit your exposure to volatility, meaning limiting your exposure to the downside. You're also going to be limited on your exposure to the upside as well. Now, volatility isn't always a bad thing, right? Because we said volatility is when things go down, but also when things go up. We want things to go up. So volatility is also the driver of returns. Typically, in typical finance theory, the main reason you have returns in equities is because of the volatility. If there was no volatility, if things were flat, there wouldn't be any returns. Returns are basically, the reason there are returns in stocks is because of the inherent volatility. And then you could add mathematical concepts to that as well. You can see what's the typical standard range of volatility, and you can ask if there's in addition to that standard range up and down motion, you could see if over time a particular equity or a particular index of equities has a trend upward. So even though things are moving up and down, they're moving up and down along an upward overall trajectory. So that's possible. That often happens in North America and quite a bit in Europe and developed economies, especially over the last 100 years, where we see a general kind of economic positive trajectory over the long term, and then volatility around that. Another way, people would call that would be the drift rate, a positive drift rate with volatility around it. But so volatility is what makes stocks risky, and volatility is also what makes stocks potentially lucrative. That's it. That's exactly it. The reason you can lose money in stocks is because of volatility. So if you've invested $100 today and the stock goes down to 50 tomorrow, that's an aspect of volatility. Now, again, there's other schools of thought where those schools of thought place less importance on volatility and more importance on other aspects of investing, but that doesn't make volatility not true. Any investor could see that there exists volatility in the market, and that that volatility makes investing quite unpredictable in the short term, and quite unpredictable in the medium term as well. And they'd see that the main driver of their kind of investing returns is that volatility itself. If things drop down and they buy low, and then things recover to kind of the normal range, and then go up again, maybe to an overhyped, over bullish, bought range, then it's the volatility that drives those. There's not really anything else that does it when you're talking about the stock in particular. Now, again, you can take 10 steps back and say, hold on, dude. Just quit talking about volatility. Quit talking about the stock. Talk about management. Talk about their balance sheet. Talk about their products. Talk about their ability to raise prices and maintain good prices. Talk about all those things. Yes, all those things are true, very true, and deeply relevant for investors. But a typical finance professor would bucket them all and say all of them for each company exist. When you're looking at a chart, when you're looking at the price table of a particular equity or an index of equities, all that kind of goes into the background, and you're seeing the most crude, high level kind of amalgamation, a metric that is an amalgamation of everything, which is the price of that stock, which is dependent on the trade, on the order flow, on the trades, not order flow, on the actual trades that are happening, on the actual last trade that's happening in the market. And so that's why stocks are risky. Stocks are risky because you don't know what the price is going to be tomorrow. You don't know what's going to happen. That's true with any equities investment, unless it's like one that has additional hedging products kind of around it, right? Or unless it's like a unique investment where you're buying. There are particular unique investments where you're buying things that are like pass-through investments where you're just owning a fixed asset where there is no volatility of the underlying asset. But I'm just talking about a normal company. So that's true with stocks, and that's true with everything. It's true with crypto. It's true basically with anything where the returns depend on certain factors, either the efforts and endeavors and kind of output of other people, or on supply and demand dynamics. So we're gonna stop that discussion here, and we're not gonna go deeper on the volatility side. But the general gist of the video was what makes stocks risky. The title of the video or the thumbnail, I guess, is gonna be what makes stocks risky. And what makes them risky is the volatility, nothing else. It's the fact that they move up and down. What makes them risky is the fact that they go up and down. That's what makes it risky. Investing in anything that goes up and down inherently is risky, because you don't know when it's going to go down and you don't know when it's going to go up. And so you inherently can't match not the duration of the investment, but kind of match when you're able to take good profits with when you'll need to take profits. So if in 5 years you're going to put a down payment, you don't know what's going to happen in 5 years with the stock market, right? So it's very difficult or almost impossible to kind of match those two durations. If you're investing in the stock market, then you know in 5 years maybe it'll be at the lowest point, and then 5 years down the road maybe it'll recover and it'll be at the highest point. You would need something less volatile if you want to keep your money around, in nominal terms at least, around for 5 years, and so that's available in 5 years for a down payment. you're going to want to keep that money in a less volatile instrument. So, and this is true in psychedelics as well. So this channel is obviously on the all about the psychedelic space, and it's true in the psychedelic space as well. You have volatility in the psychedelic space as well, just like with anything. Now, there's different levels of volatility as well, a little bit more of an advanced concept. You have not everything's volatile in the same way. So something that goes up just a little bit, up and down a little bit like this, is less volatile than something that goes up and down a lot, and that's less volatile than something that goes up and down, something extreme, right? So there's different levels of volatility. And again, we're not going to get into this, but they can be quantified. Someone can quantify them and put a number on those with levels of volatility and compare it. And I could say, oh, Ford is less volatile than Tesla. Tesla's less volatile than MindMed. MindMed is less volatile than some crazy penny stock. So you have a spectrum of volatility. And then all the volatilities in your portfolio weighted appropriately across the market cap of that, weighted appropriately across this position size, the relative weight of that particular position in your overall portfolio. You can calculate, by doing that, you can calculate, using that concept, you can calculate the overall volatility in your portfolio. Not that it's something you'd always want to do. Most investors don't calculate the volatility of their portfolios all the time, and I don't do that as well. I don't really calculate the volatility like that in my portfolio. Of course, this is not financial advice. This is infotainment only, and take everything I say with a big grain of salt. Not financial advice. So be very prudent and careful. So the typical measure of this volatility is a concept called beta. The concept of beta. So you can look up any stock and find its beta. And what the beta is a measure. It's a mathematical calculation. I'll show you guys how to do it later on in Excel. It's very easy. It's a calculation you do to calculate how volatile a stock is relative to the market. So you pick a market, and say you have the US equities market. You would have to have a proxy for that market because you're not going to include every stock in the US. So a typical proxy would be the S&P 500. 500 stocks, pretty broad, large market cap. Not the best proxy because smaller cap companies aren't represented well in the S&P 500, and typically smaller cap companies have larger volatility and typically larger returns than larger cap companies, which are typically represented more in the S&P 500. So it's not the 500 largest companies, but these are larger companies that are in the S&P. I believe they're not the 500 largest. I think Dow 30, actually S&P may be the 500 largest. I'm not sure about that. That's a good question. Let me check on that. That's actually an interesting question here. Let's take a look. I should know that one. So the question is the S&P 500, that classic index, is it the largest 500, or is it just 500 of the main? What? My phone died. So we'll see about that. I guess that wasn't meant to be for me to find out right now. I think the Dow is not the largest, and I think there's some attenuation. I don't think it's just purely the largest. I don't think it's exactly always the largest, right? Because Tesla would have been in earlier than it was. I think it's the largest plus some other requirements like profitability, I think. So you have this concept called beta, very important. If you went to any master's, undergrad program, PhD program in finance, you'd be intimately familiar with the concept of beta, and you understand kind of how to use it to compare the volatilities of different equities, and you'd understand how to use it to calculate certain other kind of measures and metrics like required rates of return or net present value. Or how to discount, you'd be able to discount cash flows and find the net present value of things. But so again, kind of reiterating and summarizing the topic. What makes stocks risky is the volatility. Volatility is present in everything that has an up and down motion like that. And there's a way to put a number to it. You can actually put a number to it to volatility. One of those numbers, the most popular way to do it, is called the beta. The beta, and the beta is basically measuring the volatility of a stock relative to the volatility of the overall market. You don't really do it to the overall market, you do it to a proxy for the market, typically like the S&P 500 or something similar, and then you can compare them. And so why is it even useful to think about volatility? What's the point of this discussion? Let's back off from all that for a second and take a big step backwards and kind of get a bigger picture here. What's the point? Probably everything I said here is already known. There's nothing brand new I'm saying, nothing unique. It's basic shit I'm saying here. But it's important to think about volatility and keep that kind of concept in the back of your mind as you're investing and as you're thinking about your investments. Because in my personal life, and I think in many people's investing strategy, I've seen my family and friends make this mistake as well. We get overly confident, and we seem to think or kind of have this intuition or notion or belief that the world is less volatile than it really is, or that it's not particularly volatile for us. So we invest in a stock, and because our thesis for that stock is good, because the right people are talking about that stock, because that stock has a good balance sheet, good trajectory, good cash flows today, or potentially looks like it may have good cash flows if certain things happen in the future. The cash flow may be contingent on certain things like FDA approval in the case of psychedelic stocks, but we think, potentially if you're an investor, you think that in the future there's going to be good prospects, and you get into the state of belief and like confirmation and confirmation bias, and nobody wants, nobody who likes a stock and wants to invest in a stock is going to want to be told, hey, there's uncertainty and riskiness. All we want is just more comforting, saying, yeah, you're making the right decision. And so that's what you seek, keeping volatility in the back of your mind, knowing the inherent nature of the markets, knowing the inherent nature of equities, the physics of it, the physics of it, how prices are determined. They're just two human beings making a trade, or two algorithms, two computers making a trade, and that's the last price you see. It's not like some survey where everyone thinks and talks about the price and votes on what price. No, it's just literally an auction, and whatever the last transaction is, buyer and seller, boom, they make a transaction. That at the price at which they make the transaction, that's the market price, and that's the price you see. When you have that in mind from that basic level, right? And you understand there's two humans involved with all the craziness, you know, that humans bring to the table. Even if these humans are not like, maybe they're not trading for themselves, maybe they're trading for their firms, maybe there's a bunch of other things happening in the background, but it's still two people. It's just people, or two computers which are designed by people, and it's just that latest price. So of course that price is going to be shifting up and down all throughout the day and all throughout the year, and it's just going to be a volatile thing. And again, like I said, you can measure that volatility, and you can compare, and you could say I want a less volatile or more volatile stock, or I want my portfolio to be more or less volatile. But when you keep in mind that, okay, whatever I'm buying, like the price at which I'm buying, the price at which I am buying is just determined by these two people, just two heads that come together, or two computers that come together and make the final one transaction, the latest transaction, 1 second ago, next transaction, next transaction, next transaction. Just each one of those, that's the price. When you realize that, you kind of you take a step back and you say, whoa, hold on, like maybe I shouldn't put so much belief, or like I shouldn't put so much weight on the current price. Maybe I should realize that the current price or the future, like I should understand that this thing is not really founded on much, it's not really based on much, it's just literally based on the last transaction, whatever the incentives of those two people are. It's not based on the incentives of any or desires of any other stockholders. Just the two that did the last transaction for that market setting price. And so it'll add a lot of prudence into your investing approach. It'll add a lot of I'd say skepticism and potentially common wisdom, potentially if you approach it the right way, to your investing portfolio, and it'll help you manage risk more appropriately. It'll help you be less erratic. It'll help you be less anxious, and it'll probably help you, hopefully it'll help you manage the risk in your portfolio better, right? Prudent risk management is key. Prudent risk management is fundamental for investors, especially small investors like us, where it's all up to you, dude. It's all up to you. And capital loss is an evil and terrible thing. You don't want to lose your capital. So you have to keep volatility in mind. Always. You have to keep volatility in mind, because capital loss is a dark and unpleasant thing, just like Warren Buffett says. Rule 1 of investing: don't lose money. Rule 2: don't forget rule 1. Those are Buffett's rules. They sound cliche, they sound so basic. Could anything be more basic than that? Rule 1: don't lose money. Dude, but it's not basic. It's not. For excuse me there, that was that sound. Um, but it's not basic. It's not, right. A pro investor, an advanced investor, knows that's not a basic concept and it's not a cliche concept. They know that they need to continuously refamiliarize themselves with that concept and with the basic concept of volatility over and over again, and they need to continuously remind themselves how uncertain the future is, how little they really know, and how prudent and robust they actually need to be if they want to succeed in investing over the long haul, over the very long haul.